Just keep buying. Part 2. Where to put money: stocks, bonds, property, or REIT? An employee laid out the savings of years. A hot stock was flashing on the phone, the broker was suggesting a bond, and relatives were advising to buy property. The decision appeared easy, but it was not. If they chose the wrong asset, the money could get stuck for years. The market could fall, a tenant could leave, or a product showing high returns could swallow their savings. This is where the most important question arises when investing has to be started: what after all should be bought? Stocks, bonds, property, REIT, or some way whose name has not even been heard yet? In the previous part, we understood that investing prepares income for the future self, tries to save purchasing power from inflation, and turns human capital into financial capital. We had also seen that just keep buying does not mean blindly buying anything. It means, after emergency protection, keeping regular investments going in an understood diversified plan. Now the story moves forward from why invest and reaches where to invest. This is where many new investors get stuck the most, amidst confusion, marketing, and incomplete information. On the internet, every guru appears to have a secret path to wealth. Someone calls only stocks right, someone property, and someone describes new technology as the ticket to the future. 𝐮𝐸𝐿𝐴's thinking is different from this. There is no single door to building wealth. Different people can build financial capital through different assets, businesses, and skills. Look at every asset on 5 touchstones: expected return, risk of loss, liquidity, maintenance, and cost. After that, add tax, time horizon, and your own emotional capacity to the picture as well. First, let's talk about stocks. Upon buying a stock or equity, you do not give a loan to a company. You buy a small part of ownership in that business. If the company grows, earns profit, and deploys capital wisely, the shareholder can get value growth or dividend. If the business weakens, that same ownership can also give a loss. Long global market records show that diversified equities have built wealth after inflation in many countries. Due to this very growth potential, stocks remain an important part of long-term portfolios. But historical return is not a promise. The old average does not tell what will happen next year, and the future of any single country, sector, or company is not like the entire global history. In the past century, markets saw wars, recessions, and financial crises, yet broad equity wealth grew. But many investors had to tolerate deep declines and long recovery periods in between. That is why the real cost of stocks is not just volatility, it is your behavior. If you sell in panic seeing the portfolio fall on the screen, the data of long-term returns will not help you. A decline does not come on a fixed calendar. It would be wrong to say that a fixed percentage loss will definitely happen every few years. The market moves in probabilities, not according to a timetable. Just as large a reward potential there is in equity, there is equally as much uncertainty too. Therefore, next month's school fee, emergency cash, or money for a loan to be repaid soon should not be in stocks. Now the question comes: buy individual shares or a fund? Upon choosing one company, the return can be very large, but the risk of business failure, competition, and management mistake is also concentrated. A broad index fund gives exposure to many companies at once. Because of this, the poor performance of one company does not cause as much damage to the entire portfolio as can happen in a concentrated holding. In India, funds tracking an index like Nifty try to catch the performance of a fixed part of the market. They do not guarantee giving the best performing companies at all times. The goal of an index fund is not to beat the market, but to follow the chosen index closely after costs. Therefore, along with the expense ratio, it is necessary to look at tracking error and fund structure as well. A dividend is not a free bonus. When a company distributes cash, that money comes out of the business. An investor's total return is formed combining both price change and received distributions. An international fund or global index can reduce the concentration of country and currency. But new risks like foreign taxation, currency movement, fund limits, and local regulation also come along. Therefore, equity can be more suitable for that goal, which has a long time to completion, and in whose journey the investor can stick to the plan even after seeing temporary losses. Now let's move towards bonds. While buying a bond, you do not take ownership. You lend money to a government, company, or other issuing entity for fixed terms and duration. The issuer generally pays interest in the form of a coupon and promises to return the principal at maturity. But the coupon rate, market price, and the yield received by the investor are not always the same thing. Government securities, state loans, and corporate bonds are debt of different borrowers. Their maturity, liquidity, tax treatment, and repayment risk can be different, so a decision looking only at high interest is incomplete. In Indian central government securities, default risk is considered very low, but the market price can change if sold before maturity. If interest rates rise, the price of an old fixed-rate bond can fall. In a corporate bond, the issuer can fail to make payments. Often a higher yield is the price of this additional credit risk, so a high coupon cannot be considered proof of safety. It is also wrong to assume that bonds will always rise, or that a bond will give profit as soon as stocks fall. In many periods, both assets can weaken together, especially when interest rates change rapidly. Then why keep bonds in the portfolio? Because bonds with good quality and the right maturity can show behavior different from equity, reduce volatility, and give stability for future cash needs. In the March 2020 panic of the US market, bonds gave some cushion to stock bond portfolios. But this is a historical example, not a guarantee of repeating exactly the same pattern in every next crisis. The duration of a bond matters a lot. A bond with a long duration is generally more sensitive to interest rate changes, while a short duration can reduce price movement to some extent. Holding an individual bond until maturity can make cash flow clearer, provided the issuer pays. A fixed maturity for a bond fund is not necessary, and its NAV keeps changing with market conditions. In India, investors can look at routes like government securities, debt mutual funds, and bond ETFs. While choosing a product, understanding credit quality, duration, liquidity, cost, and taxation is necessary. A bond allocation is not an exact replacement for an emergency fund. On a day of need, a bond fund can be down or there can be a price loss in selling an individual security, so keep the planning for liquidity separate. Now we come to that asset which many Indian families consider the safest: real estate. Property can give rent, its value can increase over time, and it is a visible asset. The specialty of property is leverage. A buyer can control an asset with a little equity and a large loan. If the price increases, the gain can appear large on one's deployed capital. But leverage works in both directions. If property prices decrease, rent stops, or interest costs rise, then even a small decline can turn into a large loss on the owner's equity. The purchase price is not the total cost. Stamp duty, registration, brokerage, loan interest, maintenance, repair, tax, and selling expenses can make the real return quite different from headline appreciation. Real estate does not sell in one click like a stock. Finding the right buyer, checking documents, and completing payment can take time. This very illiquidity becomes a big problem in an emergency. Upon putting money into one flat, the risk becomes concentrated in one location, building, and tenant market. If the demand of that area falls, no automatic protection of diversification is received. Being a landlord sounds like passive income, but vacancy, tenant disputes, repairs, and collection can make it an active responsibility. Keeping a property manager reduces the workload but increases the cost. One's own home and an investment property are not the same decisions. One's own home gives stability and personal utility. An investment property should be looked at on the touchstone of rent, expenses, loan, and expected return. In India, before property, checking the title chain, encumbrance, approvals, possession terms, and where applicable, RERA details is necessary. Just a brochure or an agent's word does not secure ownership. For those investors, REITs give a middle path who want exposure in income-producing real estate but do not want to buy an entire building and manage tenants. A REIT takes capital from many investors and puts it into offices, retail spaces, or other income-generating properties. A professional manager runs the assets, and the eligible cash flow reaches the unit holders. Listed REIT units can be bought and sold on the exchange, so liquidity can be better than direct property. Indirect participation in multiple properties with a small amount can also be possible. But a REIT distribution is not fixed interest. If occupancy, rent collection, debt cost, asset sales, and management decisions change, both cash distribution and unit price can change. In India, listed REITs work under SEBI's regulation and disclosure framework. Yet, being regulated does not mean that returns are guaranteed or capital is completely protected. The price of a REIT can be influenced by interest rates and equity sentiment. In an economic slowdown, if office demand or retail footfall decreases, both property income and market valuation can come under pressure. That is why it is wrong to consider a REIT as a safe bond. The impact of real estate, leverage, and listed market volatility, all three can come into it, so it is better to understand it like a risk asset in the portfolio. Direct property gives control but demands more capital and hard work. A REIT gives convenience and liquidity, but the manager takes property decisions, and the unit price changes daily. Outside this, there are also assets like small business, franchise, angel investing, farmland, and royalties. There can be opportunity in these, but information is less, liquidity is weak, and investor involvement can be quite high. Writing a fixed annual return on these alternatives would be misleading. One successful business can grow many times over, while another can lose the entire capital. An average figure does not tell individual outcomes. Gold does not produce income, but some investors consider it a diversifier against uncertainty and currency risk. Its price can also fall, and the real return can remain weak for a long time. The value of crypto, artwork, and collectibles can depend mainly on the demand of a future buyer. Due to high volatility, custody, fraud, and liquidity risk, considering these as core retirement income is dangerous. Therefore, short-term needs require stability and liquidity. Long-term growth can be given the time of equity. Suitable debt can be looked at for regular income or lower volatility, and real estate or REIT for optional diversification. This does not mean a fixed percentage. The dependents, loans, job security, goals, and capacity to tolerate loss of two people with the same salary can be different. Therefore, their portfolio will also be different. Diversification is not just increasing the number of assets. If 10 holdings fall together in the single same economic shock, then despite the names being different, the portfolio is not truly diversified. With time, a winning asset can become very large in the portfolio. Rebalancing controls risk by bringing it back towards the fixed range, although steps should be taken only after looking at tax and transaction costs. This is the real lesson of Part 2. Stocks can give growth, bonds can add stability, property gives control, and REITs make access easy, but no single asset alone is perfect. Just keep buying works only when you understand what you are buying, what work it does in your goal, and what the reason is for holding on to it during difficult times. But the next danger is hidden right here. If broad equity is useful, why not try to earn even more returns than that by choosing an individual stock of some spectacular company? In the next part, the hidden risks of individual stocks will open, why a few winners drive the entire market, why identifying them early is so difficult, and how even a great company can become a poor investment.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible, but in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.